welcome everyone once again for the next episode. Today we actually have a very, very interesting person here to talk about how to move from theory to practice. I have Andreas Bluemke, author of the How to Invest in Structured Products. I have it here, Andreas, which again, it is one of the books that I first read in structured products. And again, I think I mentioned this before, but when I was introduced to structured products 20 years ago, I was given a term sheet, a document, and I was told to try to figure it out. The book was not published back then. I think you, Andreas, you made the life of everyone being introduced to structured products much easier. So thank you.
Thank you. Thank you very much for this introduction.
Look, I want to start because also to talk about the evolution of structured products. And why do you think, Andreas, that structured products still matter on modern portfolios?
Well, I would say, so first of all, thank you for inviting me here. I would say to begin with, structured products are the only way to embed volatility as an asset class in portfolios. Value can be extracted from buying and selling volatility, and structured products do exactly that. And as a second thing, I would say that the real raison d'etre of structured products is that they can be used to adapt the risk return of an asset class, say a stock or an index, to the preferences of an investor. So not only increase or reduce the risk, but really bend the distribution of the asset closely to what an investor wants. So think of achieving a target return while simultaneously minimizing the risks of not achieving that target return. And no other asset class does that. And even the portfolio construction using classic assets like bonds, stocks, alternatives has limits in this respect. So structured products go way beyond that. And I think that's the main key, or the key for using structured products in portfolios.
So Andrea, that's very relevant, right? And actually, interesting fact, my wife started listening to podcasts and she says she doesn't understand 90% of what people say.
Oh my God.
So to go back and to talk about like your main idea of the book, right, was distribution, returns distribution. Can you tell us how do you look at distribution of structured products? How do they differentiate and how people can use it? Because it's easier for you and me because we look at these every day, but most people don't.
Yeah. So basically, what I meant by when I wrote the book, and what I meant by skewing and bending the return distribution is the following. If I make an example, if you buy a stock, you can make 1 year you make a plus 20%, and another year the stock might lose and you may make minus 20%. So the distribution is kind of evenly distributed, and there's a mean over the years that the stock reaches. Now, structured products are based on an asset, and here in this case we take a stock as an example, and we kind of use this stock, but plant options on it. And so basically, for instance, we remove the possibility to lose the 20%, and we also remove the possibility to gain 20%. But we say, look, as long as the stock doesn't lose more than 30%, you gain 5%.
Yeah.
You can't gain more, and you will gain these 5%, they're guaranteed, but you won't participate to the upside anymore. And as a counterparty, you will also not participate to the downside. So basically, if you are risk averse and you have a certain target return, structured products are made for you.
But of course, the word structured products means a lot of different things for different people. And again, if you think about the distribution, return distribution, how you split your structured products categories and what type of distribution will you types?
Well, once more, it depends really on the investor's preferences. So if I'm sitting in front of a bond investor, I will probably pitch capital protected notes because they will correspond to a large degree to his preferences. He will want a steady stream of income. He will not want to lose capital, and he will basically be more in for the long term. And capital protected notes do exactly that. They prevent losses, they allow participation or some kind of reward for being invested in some asset, like a stock, or like FX, or like credit. Some give a coupon, others do have a participation. So that's the first type of product, capital protection. Then if I'm sitting in front of a person who would really want to reach a target return like 5% per annum, 10% per annum, but minimize the shortfall risk, meaning that the person is also risk averse, but he
Yeah.
may take a little bit more risk than the capital protected investor we talked earlier about. Then I would go for yield enhancement products. So it's reverse convertibles, barrier reverse convertibles, autocallables, and the like. And the last category is participation. And here I'm more addressing stock investors. I can, for
Yeah.
instance, transform then the stable dividend into an outperformance, for instance. So if you are very bullish on a certain stock that pays a dividend, we will use this dividend to provide you with, say, 200% participation on this stock. But you have no protection in that case. It's a one-to-one on the downside. So if you're wrong, you do lose capital as if you would have owned the stock in the first place.
So Andreas, I think this is quite interesting, right? Because you wrote a book many years ago, but throughout your career, you've been a user of structured products, which is why we would put the theory from theory to practice. If you, again, you already talked about being able to shape your returns distribution, but if you had to simplify to advisors out there about what are the advantages as well as the risks of structured products, how would you summarize those?
Well, the advantages are quite clear. As I said, you can basically produce your own product for as little as 10 or 20,000 Swiss franc, dollars, or euros. So basically, the flexibility to structure them is enormous. You can also tax optimize them, but for the, I would say, normal investors, there is much intransparency because the entry barriers are relatively high. You'd need an advisor to structure them. They are not readily available. Or those that are, sometimes they're sold out, and sometimes, I mean, structured products have the particularity that they mature.
Yeah.
And the lifetime of a product is, say, on average 1 year or 9 months, something like this. And so to find a product that fits your foot is not so easy. Often you have to create it, and the process of creation is basically what prevents people from entering these structured products
Yeah.
readily.
So again, I would imagine that you have a lot of conversations with investors, with stakeholders in financial services beyond structured products. What do you think are still the misconceptions that still exist on with structured products?
Well, one misconception is actually complexity. People think structured products are extremely complex. They are made by quants who actually try to hide something. This is only partially true. Yes, there are complex structured products, but I would take an analogy here for a wardrobe. An IKEA wardrobe has a plan of 25 pages to be assembled. So you buy the stuff, you bring it home, and then you take the next 5 hours to assemble it, and then you have a beautiful wardrobe.
Yeah.
But you have to read the assembly instructions to do so. The structured products are not different. You have a term sheet, and as you mentioned earlier, 20 years ago, the term sheet was 1 page long or half a page. Now it's like 15 pages, but okay, the last 14 pages are disclaimers you actually don't need to read. So you need to take the time just to read the term sheet. And once you read it and maybe you talk to a specialist, it's not so complicated to understand.
Yeah.
And then once you've done this, you need to make the effort. But once you've done this, you understood what you're investing in, and then you have a beautiful structured product.
I find it very, very interesting, right? Because people have that misconception, right? But you have the same thing. But you have the opposite on ETFs, which says they're transparent. Actually, most of the times, if you give me the term sheet of ETF, it's not even clear, right? How do they invest? What are the conditions? It seems to me that there is like a disadvantage because you have this product that got the reputation, but you have the ones that actually don't even give all the full information.
The curse of structured products is actually that they don't exist before someone has created them. An ETF will exist, and there will be literature, there will be a web page, and there will be graphics, I don't know, descriptions, whatever. A structured product is non-existent until someone has created it. And that process of creation is basically the entry barrier for structured products versus already existing products. Everybody knows Nestle, everybody knows Johnson & Johnson, everybody knows NVIDIA. Nobody knows the next barrier reverse convertible on those stocks.
It's interesting you say that, right? Because you have this focus on trying to change that, right? With funds, with SMA, separate management accounts in the US and in Asia. You also have the AMCs trying to take out that complexity. But for me, you lose something when you're trying to go to something which is there generic, but you never know like what are the new. I don't know. I find it interesting. Interesting view, but at the same time, it loses some of the flexibility that like securities, like notes, certificates have. What's your view? You've seen that change in the industry.
Well, speaking of AMCs, yes, I actually do manage an AMC of structured products. The goal for this was basically to prove that you can make a good risk return with structured products, with classical structured products. So as I mentioned, structured products don't exist. They have to be created and they expire. So sometimes they work, they produce a good return. You get your coupon, you get your participation, you get your capital back, you're happy, etc., etc. But how do you measure performance over time? If you take it for your own portfolio, you may have one product here, another product there. Most people use these products as a, say, side bet or side portfolio. But if you want to really get into it from a core, then basically you need to measure the performance over time, and few people do that. Having, I would say, a track record is quite important. Actually, the Swiss Structured Product Association just created benchmarks for structured products. So it's yield enhancement benchmarks. Basically, the concept is to have a Barry reverse convertible on 3 indices: Eurostoxx, S&P, Nikkei, 1-year maturity, and it's being rolled over every month. So basically, for the index comprises 12 structured products of the type I just mentioned. And if you backtest this, it worked quite well. It produces a good performance, a good risk-adjusted performance, I should say. And what I'm trying to say every time I'm meeting a client is, look, what do you want to achieve? And if it's the first time the client or the investor touches structured products, I try to pitch him this type of product, something which has no idiosyncratic risk, only systemic risk. So not on a stock, not on several stocks, but on indices, because they are already broadly diversified. And the risk return is actually worth the effort. Having these benchmarks is a good, I would say, evolution in this market.
I do want to because there is now a big topic in the industry globally, which is the worst off, especially single stock worst offs, right? Because you've seen, now and then we have been in this since for 20 years. Every 2 years there is a massive crash. Some bank loses a lot of money on hedging these products. Sometimes there are some products that perform bad, and there is this now fear about the worst offs, especially on single stocks that include Tesla, that include other, Stellantis, other single stocks, the BCE in Canada, that people are buying these as baskets. They think that they are baskets, but in reality, it's a worst off, which of course takes the risk of the lowest performance. So it's much higher risk than a basket. How do you see that? And again, I guess we can split it right between equity indices where you have only systematic risk, right, versus shares where you have risk which is individual to those stocks, to those CEOs. How do you see that, and how do you manage that correlation risk?
Yeah, I mean, there's 2 things I want to say about this. First of all, any investor who actually buys or subscribes to a structured product must be comfortable with the underlying assets that the product is based on. So the investor must be aware that in case there is a market downturn, these stocks will be delivered to his account. If it's a Barry reverse convertible, they will be delivered to his account at the strike price, so at the spot. And if it's a reverse convertible with a lower strike, then the risk comes in at a lower level, and that would be the price at which the client should be fine in purchasing these assets. The other thing is communication. I mean, these worst offs, they play basically correlation. Basically, you get a higher coupon by entering the imperfect correlation between these stocks. Because, as we mentioned, the worst off is the one that gets delivered in case it breaks through the barrier or gets below the strike. But the correlation actually gives you some more coupon for that. Now, what people have to understand maybe is that it's useless to have always 3, 4, or even 5 stocks in the worst stuff, because the added value of the third, fourth, and fifth stock is diminishing. So I would suggest take only 2 stocks, be comfortable with the 2, and because also if you have 3 or 4 stocks in one stock in one product, sorry, and you have like 10 products in your portfolio, having worse stocks kind of is very difficult to manage your portfolio from a risk perspective, because you don't know exactly what you're exposed to.
Correct. Yeah. Especially I can see because we help managing portfolios of structured products with life cycle information, and especially on clients have a lot of single stocks, worst offs. It changes a lot month to month, all right? Because
but this is
the
why
performance can change.
This is why I say use indices. I mean, you don't get so much less coupon from indices, and indices are just naturally diversified. You don't have if you take a 30% protection on a stock. I mean, yesterday we had, or 2 days ago, we had this company, Fiserv, a US company, which dropped like 44% in one day.
Yeah.
So indices don't do that. The S&P will not drop 44%. The Nasdaq will not drop 44%. Nor the SMI or the Euro stocks. Yeah, no. We can all go and plant potatoes in our garden if this happens.
That's true.
Probably. But yeah, you take much less risk by going on by taking indices instead of stocks. The indices don't get delivered, but ultimately, when you do a barrier reverse convertible, you must feel comfortable to be invested in the stock, I said earlier. But actually, you don't want to get this stock when you do a barrier reverse convertible, because that would mean that the barrier gets broken. And this is really the worst that can happen to you, is you buy insurance against a drop in the market, and then the insurance doesn't work because the drop is stronger than you think. It's like buying a fire insurance on your house, but if the fire starts with a lightning bolt, then you're not insured. It still destroys the house, and you have paid insurance for nothing. This is the worst thing that can happen to you. And the same.
It's a very good point, and I think structured products don't get the credit also for being a way to access indices, right? Because most investors cannot buy indices by themselves. I mean, they can buy ETFs, they can have mutual funds, but structured products are also a very clean way to get exposure to those indices with the addition, right, of being able to play their distribution and have the insurance. Anyway, that's my view. I'm not sure if you agree with that.
No, I'm sure. The indices have this characteristic that normally markets rise, right? This is the basic of capitalism. Companies produce something, they pay their employees less than what they produce, they make gains, and ultimately these gains are either paid out in dividends or are reinvested in the company, or the managers make stock buybacks, and so markets tend to increase little by little. There's the volatility because sometimes there are exuberations, so people speak about bubbles and then everything crashes. But normally managers and investors are more or less rational, and indices tend not to drop by so much, especially because indices are also self-correcting. If you have bad companies in indices, they are being thrown out by index rules, and they are being replaced by new companies which have a better prospects. So all in all, I do prefer indices.
So we went well above in terms of what is happening, but I also want to get your opinion. On the last podcast, we talked a lot about Lehman Brothers, 2008, what happened with the evolution. How do you see the structured product market after 2008, after Lehman Brothers, right, which was a big player on structured products, especially in Asia and the US, but still present also in Europe? How do you see this industry now versus before 2008?
Well, before 2008, I mean, you speak of Lehman Brothers. My first structured product was actually 10 uncommon values. basket of 10 stocks issued by Lehman Brothers. That was 1997. It went very well. Ultimately, Lehman went broke. This triggered actually a concept which was not so much known before, and that is counterparty risk. Counterparty risk is now something you have to look at. Basically, each structured product is issued by a counterparty, usually a bank, and this bank has a certain credit rating. And maybe what you don't want is to have too much issuer risk in your portfolio from the same issuer. That is something to look at. Otherwise, I mean, we are still a little bit stuck with this counterparty risk, although I must say times have changed. The balance sheets of banks are so much stronger, at least of the big players. They have so much more capital at their disposal. The regulator has actually forced them to keep a lot more capital than prior to Lehman Brothers.
Correct. I think you're right. Although, interesting fact, I'm not sure if you know, but all the structured products that were live during the bankruptcy, they continue to be live. 70% of them actually return positive returns even after the bankruptcy, which I find it a very interesting fact. Not saying that it was not an easy situation, right? Because you get your money stuck, you need to wait, see what happens. But anyway, ultimately it ended up positively for most people. Now let's talk about design and delivery, right? How do you define a good structured product when it comes to its payoff? What do you look at? What are you trying to look at it when you're trying to buy a good structured product?
Well, it depends. If I'm sitting in front of an investor, then the key for me is listening. I listen to the person and I try to determine what are his preferences, because basically there's an infinite choice of products that I can structure. And it's a little bit a trial and error process that I do with clients. You have to listen what the investor wants, roughly, basically. Then you make a first proposal. Then he says, okay, fine, but I don't like this stocks, or I lost money on this market, I don't want to. You have to deal with a lot of irrationality of investors. But ultimately, the longer you listen, the longer you pinpoint the product that you want him to buy. And when you make the pitch, you have basically assessed all his risk return parameters. And normally, when you're a little bit experienced, you have an 80% ratio. So you propose the structure and the client accepts.
So how do you balance, protection, risk, yield, market exposure? Because you talked about that on your book, but you have all these different profiles, right? But how do you balance all of this? Because it's a lot, as you said, and you still have to put on the other side the investor preferences.
Yeah, I mean, balancing risk protection with yield and market exposure is tricky. So if I make a small ex cathedra with, say, let's take reverse convertibles, the easiest product. So basically, you lower the strike to lower the risk, and at the same time, automatically, the coupon you get out of the structure gets smaller as well. And there is a point at which the model, which mathematically calculates the coupon behind, says, look, at this strike, it's practically impossible that in the allocated time, the tenor of the product, the stock will not drop that much. So the coupon will amount to essentially risk-free minus costs. That's basically where you have to find where the best the market exposure for a structured product is difficult to manage, because when you strike a structured product, it has a so-called delta, meaning that it measures how much this product will vary in price according to 1% variation in the market. And the thing is, this delta is not stable. So to make an example, if the market drops by 1%, the product will diminish by 0.2% when the delta is 20% to begin with. But this delta will increase with market the further the market drops, and tend towards 100%. So if you say at the beginning of the conversation, for instance, Mr. Bluemke, I would like to limit my structured product exposure to 10% of my portfolio. Does it mean that he wants 10% of his assets in a structured product, or does it mean that the delta adjusted level of risk is 10% at inception, which could then grow because the market downturn might increase this? On the opposite, if markets increase, your delta tends towards zero, and then you have basically a bond paying a coupon which amounts to the coupon of the structured product. So this this asymmetry is quite difficult to manage, I would say. So yeah, that's
Not that
basically what I
easy.
wanted to say. Not that easy to.
Not that easy to. How do you explain that to your clients? To how do you? So let's say, especially on life cycle. Okay, imagine you build a portfolio. It's going well. It's going bad. How do you? Well, especially when it's going bad, right? That's when you need to explain because when it's going well, no one asks questions. How do you explain those differences on the secondary market versus what you still believe will happen in at maturity of the products?
This is a good question. This is a very good question. And actually, this happens all the time because of this asymmetry, the structured products mark to market do not follow the final payoff, and the final payoff is sometimes a bit difficult to understand in the first place. Let me give you an example. We often issue a product which is called a shark note. So this sounds very dangerous, sharks biting hard, but a shark note is actually a capital protected note which participates to the upside, but it has a so-called knockout. And if the knockout occurs, the client loses the participation but gets a rebate. The payoff is like a shark fin, hence the name. You know them?
I know them, and I have a love and hate relationship by shark fins because
like most people.
They're a very good idea, but then in reality, most of the times you get the rebate. So it depends how you structure. So I'm interested in listening to you.
So basically, these structured products, we can make the example on gold. It's a very actual example. Gold has been skyrocketing, and we issued a lot of structured products of shark notes on gold. And yes, many of them touched this rebate of this knockout level, and the client got the rebate. Some were not happy. Others said, okay, at least I got it. But the thing is that the mark to market of these products is most of the time flat. It doesn't move. Basically, there are two scenarios. Either the market goes down, and then you basically have the price of the product which tends towards 100, 98, 97, something like this. And if the market goes up, like in gold, you tend towards the rebate of once the knockout is reached. But you never get to this 100, 120, 125, 130%. There are tricks that you can use in order to mitigate this. For instance, take a shark note on the SMI, the Swiss Market Index, but in quanto dollar. This will give you, for a 2-year maturity, 100% participation and a rebate of 45%, and a knockout at 40 at current conditions. Meaning that if 140% knockout is reached, the rebate will be 45%. Now this becomes interesting because this is like a take profit product. You don't have a downside because if the SMI drops, you will not lose your money. The opportunity cost will just be the coupon that you might have received on a bond. But on the upside, you can go up to 45%. This becomes a love relationship because there the mark-to-market tends rapidly towards the rebate.
The rebate, because then,
This is a bit when we structurers, we see ourselves a little bit like the mechanos of a car. We know how to fine tune the motor, the engine. We know when to brake, when to accelerate, etc., etc. Maybe most relationship managers and also some investors have a driving license and they know how to drive a car, but few of them would know how to build the engine or fine tune it. And this is where we come into consideration.
But still, how do you educate, right? Because, same way, right? They want to know that they're going to get to their destination. And if you change, and if you change the line, right, or if the car stops or there's some noise, they will ask you questions. How do you educate investors?
Yeah, that's also a tricky part because structured products are a little bit like a language. You need to use it. It needs to be kept alive, otherwise you forget it. It's not like swimming. Once you learn it, you know it forever. Practice makes the master, I would say. So talking to clients, instilling maybe a force of habit in some clients might also work because once they fall for a product, you can basically guide them and always try to remake the same product only on different underlyings or on different markets so as to profit from certain conditions. Doing this systematically, in my opinion, doesn't work so well because you might invest the worst possible time when you have these expiries. But giving a client, say, a deep insight in one type of product that he can understand and that he can assess is probably something which I would recommend.
So, Andreas, I know we almost were running out of time. So let's talk about the future, right? As you see, market is kind of complicated with Trump, with what is happening in Ukraine, in the Middle East, with oil, gold. You know, this fights within the currencies. What are your bets, or what are you investing in for your portfolio to make it, let's say, as safe as possible?
So to make it as safe as possible, I do use European style barriers in the reverse convertibles that I strike. European barriers are observed only at maturity. There are two types of barriers you can put into a barrier reverse convertible. So basically, I am strengthening the insurance of my portfolio as much as I can.
Mm-hmm.
I repeat myself, but I do use only indices, worst of indices, because that's basically the safest bet I can make. And what I also do is I place a so-called conditional coupon on my products, because by adding this additional risk of not receiving the coupon, I can either increase the coupon or I can lower the barrier or strengthen the barrier, meaning that I can increase the safety of my product. All is done to make this barrier strong enough to withstand, I would say, at least 1.5 bear markets. So a correction is minus 10%, a bear market is minus 20. I never take barriers which are lower or weaker than 70% of spot. And depending on the index that I use, let's say the Nasdaq, I take more than 70%, more than 30% protection. So the barrier would be set at 67 or 65%.
That's a very good idea.
I
don't think most people think that way when they look at the protection.
You have also the possibility to differentiate the barrier per underlying in the same structure. So suppose I do a worst of SMI and Nasdaq. Well, maybe I want the SMI barrier set at 70 and the Nasdaq barrier set at 65. Because that way the amount of risk per underlying is evening out a little bit.
Yeah. Okay,
these are tiny tricks, but they work.
Great. Look, Andreas, you wrote this book, and thank you for it. I've read it multiple times. I always take it with me whenever I have a long flight. What is the key takeaway you want people to know about structured products?
My key takeaway of structured products is that by being straightforward and disciplined, you can make a good return, a risk-adjusted return with structured products. They are not that complicated. You must take the time to read the term sheets and don't be afraid of asking questions to a specialist and seek out the true value of them. There are some bad structured products. I've seen very bad things, and control is better than trust in this case, because you have some people who are just in there for the money. So, for instance, there are fees in these structured products. That's normal. It's a creation process, and a fair day's work for a fair day's pay. So I would say that you have to control this, that the fees are not too high. You have to check whether the product fits your portfolio. Don't invest in anything that you're not familiar with, that you don't understand. And ask questions and request access to specialists. That I would say it's the best thing you can do to have success with structured products.
Okay, thank you, Andreas, for your time. I hope you enjoyed it. It wasn't too difficult, but I do appreciate your time. And thanks, everyone, for listening.
Thanks, Fernandez. Thanks, Thiago. Sorry. Thanks, Thiago.